G'day, my name is Matt Byrne. I'm a chartered accountant and the director at Day One Advisory. We specialise in helping e-commerce businesses with their outsourced finance to make sure that you guys have really great records so that you can make good decisions with. Now, we onboard new clients all the time in the e-commerce space, and 90% of those clients we see make these 4 mistakes when they're dealing with their Xero file and generally their financial records. Now, I've got the demo file open here, and I'm going to show you a couple of things within this file. The first mistake that everybody makes, well, most people make, is using the default chart of accounts in Xero. So when you set up your Xero file from the beginning, one of the options as part of the onboarding process into Xero is to choose which chart of accounts you want to use. Those chart of accounts, more often than not, if people don't have a file handy, they just select the Xero default chart of accounts. And the reason that that is a problem is that the default chart of accounts are not built for e-commerce businesses. They are built for any type of business that might log into Xero. So the things that are relevant here are they've got one sales account. There's no breakdown between sales of products versus freight versus refunds or discounts. They don't have anything to do with D2C versus B2B sales. So the result is that all of your sales end up lumped into one account. You can't dissect it, and it's really hard to make good decisions about what's happening in the sales of your business. So the starting point is to get the foundation right, and the foundation in the Xero file is to get the chart of accounts right. If the chart of accounts are good and they're customized to you and your business, then you're off to a great start. Now, if you're not sure how to create the right chart of accounts or what accounts you should use, if you jump onto our website, we've got a link to download a set of or template chart of accounts for a e-commerce company, and you can use that as a reference point. Otherwise, by all means, reach out to our team. We're happy to set the right chart of accounts up for you. Now, the second mistake that we see all too often is that there's no integration between Xero and your online store, so Shopify. The integration that we use more often than not is A2X. Now, A2X, the purpose of it is to collate the Shopify data. It summarizes it on a daily basis based on your payment gateways, and then it sends across a really neat invoice to Xero for each payment gateway that you've had each day. Now, importantly, what it does is it separates out your product sales from your refunds and discounts, your shipping revenue. It will deal with the GST correctly, so it will separate out your reporting for international sales versus domestic. And it also will give you, where it can, for example, like with Shopify transactions, it will also give you a breakdown of the fees. So what that looks like is you'll get a deposit coming into your bank account of $21,000. Now, if you were not using an integration, that $21,000 would get reconciled directly to the sales account. But with A2X in place, it will give you a split between the type of sale, the shipping income. If you've got GST collected on it, it will also split out refunds, and if applicable, advertising, but this is a breakdown for Amazon, so there's a little bit more detail in there. Now that sends it across, you then match that up in Xero, so your accounting's super easy, and everything ends up within your reporting in the right spot. And I'll show you in a minute what a really good set of reports looks like and what you should be aiming for as an e-com business owner. Now, the third issue we see, which usually is the biggest one in terms of the impact of what your P&L looks like, is not doing inventory accounting properly. A lot of the time, business owners will buy some stock and they then buy that stock in bulk in month 1, and then they use that stock and sell it over month 2 and month 3. In Xero, what happens is the transaction comes out of your bank account, that gets reconciled directly to the product cost of sales account, and it ends up sitting in a profit and loss report with just a purchaser's number here. Now, you can see in this demo file example that we've got, they've sold $20,000 worth of product for this month, but only purchased 763. And the reason for that is that the likelihood is that they actually purchased the stock in the previous month or earlier in the year. By not dealing with the inventory accounting properly, what's happening here is that we're effectively overstating our gross profit, because in reality, we didn't make $20,183 on that $21,000 worth of sales. What proper inventory accounting does is it takes your purchases and it says, right, I've bought some stock, and it puts those to your stock on hand in your balance sheet. Then when you sell the stock, it goes and takes the cost of the stock you've sold and it expenses it through your profit and loss. That means it doesn't matter when you purchase the product, your P&L is always going to show an accurate cost of goods sold and, importantly, an accurate gross profit. So the way that you would do this, you can use a complex inventory system if you wanted, but my preference here is to use A2X. So if you've got your product cost details set up correctly in Shopify, then A2X will go and get your cost of goods sold, and it will take it based on the Shopify sales data and the Shopify product cost, and it will take that cost of sale and it will put it through your P&L and expense it as a cost of sale. You'll still need to do regular stock takes, but that's going to get the bulk of the work done for you and give you much better reporting. Now, the final mistake that we see is if you've got all of the other three things right, so the chart of accounts right, you have an integration that's dealing correctly with splitting out your sales and accounting for your cost of sales. The other thing that is more often than not missed is then how do you use that data? So you might maintain your Xero file and do a really good job, but if your reporting is not set up correctly, then you're going to end up with a report like this. This is going to have, for example, freight and courier. The reality is that's a cost of sale, cost of goods sold. So that line item here should be up in your cost of sales. But because we're using the Xero default profit and loss report, it just sits there in an operating expense account down the bottom. Now, what does a good P&L look like? Now, here's an example we've created. It's all made up data, but this is what is possible with Xero and what a really good P&L should end up looking like. So we can see here that under our sales, we have the sales split out. So we've got sales, we have our freight recovered from our customers, we have the discounts we've given and our refunds. That gives us the total net sales. Now, if you were, for example, using the wrong chart of accounts, you wouldn't see this data. You would just get this number going straight into sales. If you weren't using an integration like A2X, then again, you wouldn't be able to split that out and it would be a manual process or you'd be in Shopify trying to fish out the data from there. So we've got a great split between our sales data. We've then also got accurate product cost data so that we have proper gross profit margins down the bottom here. We've also split out things like our merchant fees so that we can understand how much we're spending on our platforms to actually process the payments. The next is we've got the first level here is gross profit. We've calculated the gross profit percentage. So it's all well and good to look at something in a whole number and say, that looks fantastic. But if our percentage is moving month on month and we don't have the ability to track it, then it's not as useful to us. So by expressing the gross profit as a percentage, we now get some really great numbers that say, hey, that margin's 58%. Last month, it might have been 65. So we can say, why has it moved? The next level down we have then is our direct advertising costs. And if we take our direct advertising costs off our gross profit margin, that gives us our contribution margin. Our contribution margin is what is the total amount of profit or money that is available after we have done everything necessary to buy the stock, to receive it, to deliver it to the customer, to acquire the customer. This will help us, or this is a very important number when it comes to things like calculating break-even points. So the contribution margin in this business, you can see, is again expressed as a percentage, so we've got 21. Now we've gone a step further here and we've actually added a calculation for the marketing efficiency ratio. It's very easy to add basic calculations like this into Xero. So why not have that level of detail in there? Now, once we've gone past the contribution margin, we actually have for this particular client, or this example, I suppose, is a second level of contribution margin. And the reason is we want to know what are our indirect costs of producing the advertising that ultimately made the sale. And what that does is it just breaks it down into another level of detail. You don't need this necessarily, but again, it depends on your business and the level of cost you've got and what types of things you're spending your money on. Now, we have then at the bottom here our operating costs. Now, our operating costs are the fixed overhead costs of the business. They're the things that don't necessarily change as the sales change. And one thing that's really important is if by splitting this out like this, what it tells us is that for this business and this particular period that this report's for, the break-even point is $159,000 worth of sales. So we have to do $159,000 at our contribution margin 2 in order to break even. Now, thankfully, in this example, this business is making a profit and that net profit is 10%. So this is what a good profit and loss should look like. And this is the level of detail that you can go to if you've got those other setups correctly. Now, we're going to do a different video that will show you how to actually format this report and how to add these formulas and different things in there so that you can produce this in your own Xero file. Now, remember, in order to do this detail, you actually need the inputs to be really good. So that's where proper systems and proper bookkeeping make a difference. So again, start with making sure the chart of accounts are right. Get the foundation correct. Make sure you have the place to put the transactions when they come in. Secondly, use an integration. It's a really good way to get proper data out of your Shopify store and into your Xero file. The third thing that you need to do then is you need to make sure that your inventory accounting is right. This reporting is not going to be worth a whole lot if you're just expensing costs as you're paying for them. your gross profit will be lumpy, and it won't be as usable data. So once you've got those things right, then you can actually start leveraging the data within your Xero file to produce proper reports that are going to help you understand what's going on in your business. Now, if all of that seems a bit too overwhelming, you guys can reach out to us. Day One Advisory specialize in this. This is what we do all day, every day for e-commerce clients, and we can help get this set up in your business so you can start making better decisions.